Welcome to Talk Tickers. Today, we're diving into Rent the Runway's latest earnings, and wow, what a report. On the surface, it looks like a total train wreck, but, the market, it told a completely different story. So, let's get into it.
All right, so let's jump right into the central paradox, because this is really where the whole story of the quarter is.
Okay, so if you just looked at the results, you'd think, yikes. I mean, they missed their earnings per share target, and not by a little, by over $1. Gross margins, they just fell off a cliff, down a whole 11 percentage points from last year. And their adjusted profit, it basically evaporated, dropping from almost $14 million to just $3.6 million. I mean, ouch.
And then, this happened. After all that bad news, the stock shoots up over 28% after hours. Just incredible. So you gotta ask, right? What in the world did Wall Street see that the rest of us were missing in those headline numbers?
Well, here's the secret. The market completely ignored the income statement. It's like they just threw it in the trash. They weren't focused on profits this quarter. No, they were focused on one thing and one thing only: survival. And one single game-changing event that basically saved the whole company.
So what was this huge event? It was all about the balance sheet. Management pulled off a massive financial restructuring that honestly is a total lifeline for the business. It fundamentally de-risks the entire company.
You see, coming into this quarter, Rent the Runway was just drowning in debt. We're talking about almost $340 million. That was the huge, dark cloud hanging over everything, the thing that could have sunk the whole ship. But with this new deal, boom, they slashed that debt by more than half, taking it all the way down to around $120 million. I mean, that is a night and day difference. It's an absolute game changer for their ability to just stay in business. And this is why investors got so excited. It's really a triple win. First, you get rid of a huge chunk of debt. Second, you get a fresh injection of $20 million in cash to run the business. And third, you push back the due date for the rest of the debt all the way to 2029. That's not just breathing room. That's a whole new lease on life. And listen to how the CEO, Jem Hyman, talks about this. She called it their IPO 2.0. That's not just corporate speak. That's her saying, we're starting over. This is a brand new company. And judging by that massive stock pop, it's pretty obvious the market heard her loud and clear. Okay, so the finances are shored up. That's great. But what about the actual business of Rent and Close? Let's switch gears and look at the operations, because this is where you start to see the trade-off. This growth, it came at a pretty steep cost. So let's start with the good stuff. Their main goal right now is to get more subscribers, and man, are they succeeding. Look at this jump. They went from basically flat growth last quarter, less than 1%, to over 13% growth this quarter. That is some serious acceleration. So how'd they do it? Well, they went on a shopping spree. They just flooded the platform with new clothes. We're talking a 253% increase in new styles in July alone. Plus, they added 56 new brands and, of course, ran a bunch of promotions. And you know what? It clearly worked. But, and this is a big but, here's the bill for all that exciting growth. The gross margin absolutely tanked. It dropped from over 41% all the way down to 30%. That's a huge, huge hit to their profitability on every single rental. And it's not a mystery where that money went. It costs more to ship all these new items, and they have to pay their brand partners for all that new inventory. So yeah, the margins got squeezed. And this really gets to the heart of their problem. The growth engine is burning cash. It's not funding itself yet. That's the puzzle they have to solve. So you've got this weird situation. The company is safe, but the business model is expensive. So what's management telling investors to expect now? Let's look at the guidance. All right, let's break down their promises for next quarter. They expect revenue to keep climbing, which is good, but look at the profitability. They're guiding to basically break even, somewhere between -2% and +2% on their EBITDA margin. That is a razor-thin target. And for the whole year, they're still expecting to burn through more than $40 million in cash. So yeah, making actual money is still a big challenge. But even with those tight margins and cash burn, management is talking a big game. They're out there saying they're now operating from a position of strength. I mean, that's some serious confidence. They are basically drawing a line in the sand and telling Wall Street, judge us from here. They've set the bar really high for themselves. Which, of course, leads us to the big question for anyone thinking about investing. The company has been saved, yes, but is it a good investment now?
In other words, where does the stock go from here? Did that huge 28% pop already bake in all the good news? Okay, so here's our call. We're rating this market perform. Why? Because that balance sheet fix was a fantastic one-time shot in the arm. The market saw it, loved it, and priced it in. The story isn't about survival anymore. Now it's 100% about execution. They have to prove, and I mean prove, that they can make this growth profitable. So if you're looking for a way to trade this, we're calling this the Prove It straddle. It's basically a bet on volatility for the next earnings report. Think about it. The company is at a total fork in the road. If they show even a little bit of margin improvement, this stock could really take off. But if they miss, and it looks like this growth is just too expensive, the market is going to punish them hard.
And as always, a quick reminder, this is not financial advice.